We are asking the question, are 5% expected real returns possible given today's current interest rates and equity market valuation? Well, our next guest knows. He's Jeffrey Scott, Chief Investment Officer at $40 billion consulting firm Wurts and Associates. Wurts invests for endowments, pensions, healthcare, insurance institutions, and multi-employer trusts and substantial net worth families. And still with us and rocking it, by the way, Clifford Asness of AQR. Jeff, I want to start with you. Are double-digit returns a thing of the past, like afros and bell-bottoms? Are they ever going to come back our way?
They are going to come back your way.
But afros
our way. Could, not me, but could. But the reality is in today's environment, with interest rates at 1.6% on the 10-year, the S&P almost back to its highs of 2008, reality is over the next 5 to 10 years, it's possible, but a very low probability. Let me give you an example. It's possible that I could be the anchor of Bloomberg News next year.
Maybe not.
But it's a low probability, right? So that's the same example. There is a possibility of making those returns, but it's a low probability.
Are investors...
Jeff, I think it was possible till you said that.
Are investors prepared for that? Do they have their heads around it? Because it was just 2006, 2007 when they wanted double digits, when they expected it.
I don't think that they've grasped reality yet. And you look at what people are discounting their liabilities at, they're still trying to use numbers back in the 80s and 90s rather than the reality of what numbers are today. So my thought is no.
What's the appropriate discount rate for a pension fund?
A lot lower than what they're showing today.
Yeah, but are we talking, I mean, with a risk-free rate effectively of 0.25%, right? What are we talking about, 4, 3? I mean, insurance companies wrestle with the same problem, right?
Probably more realistic number is somewhere around that 3 or 4%. Now, if you
That's
do
harsh
that,
medicine, right? Because a lot of them are still at 7 and 8.
You know what? And our country doesn't really want to face hard medicine. You've been talking all morning about the fiscal cliff. We don't want to face that either. So we don't want to face these pension liabilities. We don't want to face the entitlement liabilities. And here's the problem.
If I can jump in and support Jeff, because I don't want you to be the only one out there giving bad news. We're really talking about bad news on two sides of it. We're talking about bad news on the return side. We have our own way of measuring it. We try to come up with an expected long-term, not today, not the employment announcement, but 10-year on the stock market, and that has to do with where valuations and dividend yields are, and on bonds. And stocks are expensive versus history, and bonds are very expensive versus history. And our best guess is a rational expected return from today's prices. And like you said, anything can happen. There's randomness around us. Is more like 2 and change real return over inflation, when history has been more like 5.
For how much longer?
Well, that's a great question. There are basically 3 ways out of this. One of them is very pleasant, that we're wrong because earnings grow to the moon for a long time, and you can get that. You can get a boom. You know, we talk about shale technology. I'm not going to claim to be an expert on that, but if that changes the game and we get 5% instead of 2% earnings growth for the next 10 years, it changes my numbers. The second way out of it is this is permanent. Valuations are higher and returns are lower. Some theorists think that's reasonable. The good news is you don't need prices to fall. The bad news is you earn less forever. The third is the unpleasant way, where prices fall and restore some attractive valuations. Pain now for gain later.
Then do we run the risk that investors can start swimming in a pool that they're not equipped to do so? They're desperate for yield. They're not getting it in asset classes where they're comfortable investing. Could we see more and more investors start to get involved in distressed, in illiquid assets? Because it was just a few years ago so many people got burned by the illiquidity of the credit markets. Have they forgotten that?
I think so. And if you look at the trends over big institutional portfolios, they're moving more and more into illiquid assets, into assets I think that they don't understand.
Isn't that crazy?
And they're leveraging up on the same risk they have in their portfolio, which is dominated by the equity risk in the developed markets.
So Jeff, we'll go back to where we started the conversation with Cliff almost an hour ago. What do you do? If you need to generate returns, do you stomach the risk that you need to take in equities and some liquid assets and just live with that?
You know what? It's getting close to lunchtime around here. We should try to figure out where is the free lunch. And we learned in 1952 free lunch is diversification. from Harry Markowitz, but unfortunately nobody's using it.
Let's talk about what the speaker had to say and what it means. Still with us, of course, our guest host for the hour, Cliff Asness of AQR Management. In fact, all 2 hours here on Market Makers. Cliff, thank you once again. Jeff Scott is here from Wurts Associates. And, of course, joining us, you haven't seen him yet, Charles Ellis of Greenwich Associates here. Gentlemen, why don't we just talk for a moment about what the speaker had to say and whether you feel any better, any worse about what's happening in Washington. It's hard to tell whether there's progress happening behind the scenes or whether it truly is a Mexican standoff the way that the speaker describes it. Jeff?
Sure. Well, the way I look at it, everybody's talking about the fiscal cliff as if it's going to happen December 31st. We've actually went off the fiscal cliff over the last 10 years. The deficits that we have in this country, our total government debt to GDP is 100%. We're off the cliff now. We're crashed. What we're talking about December 31st is maybe removing one stitch from all the stitches we need from this crash. So reality, nothing's happening. They can't even now today kick the can down the road.
Charlie, what's your take?
We don't agree.
Ah!
You can create an excitement around a specific event by announcing that specific event and then making a big deal out of it. And you can create a lot of argument around that specific event. This does not happen as a single bolt of lightning, jump off a cliff. If the cliff comes, it's the beginning of a year during which taxes could be higher. It's also, I think, very, very hard for any of us to believe that what we will see said in public has anything significant to do with what's going to happen in private.
How about you, our own fiscal cliff?
Well, you've said that twice now.
I like it. I think it's a great joke. No one's picking up on it.
There's a fella at my firm named Joe Trenicosta who won the pool that someone would make that joke at 21 minutes. That was the first time you made it. So, Joe, 20 bucks to you. First of all,
I'll split it with you, Joe. 10 for each.
First of all, I agree with both our guests. You said you disagree. I was afraid it was going to be with Jeff, but you were disagreeing with the idea of the cliff. It's a much bigger issue. I don't think the fiscal cliff, while it's very serious, I don't think it's quite as Armageddon-ish as some do, but the entitlement crisis and what we're going to do about spending in this country is. And here's how I see it. We have two visions for the future, and I won't even argue about which of these visions we should pursue. One is a bigger entitlement state, a more European entitlement state, that must be paid for, and analysis after analysis shows this by everyone. Europe's taxes are actually far more regressive than ours. They have giant consumption taxes. So we can go that route, or we can go back to a route of a smaller government with lower taxes on everyone. But what we can't go is the route of a European-style state paid for by relatively unappealing people like me only. That just doesn't work. The president's attitude of you can raise taxes only on a small segment. I'm not defending that segment. I'm not saying what those taxes should be, but it doesn't come close to paying for the entitlement state we want. If we want, the people are being sold an entitlement state with the tagline of, and you don't have to pay for it. Right. And they will have to pay for it, and that's the choice we have to make as a country.
If all we get at the end of the day is an agreement, is not a substantive bargain, right, that actually meaningfully reduces spending and raises revenue over a long period of time, if it is, as some people like to describe it, just an exercise in can kicking again, Cliff, how long do you think it's going to take for people to realize that nothing's been solved and that finally perhaps the markets will wake up from this very sanguine approach that they've taken and recognize that there truly is irreconcilable gridlock in Washington, and we're going over some kind of a cliff at some point, and it's perhaps a bigger one than we face on January 1st?
Eric, you're asking a very difficult question. I am fond of saying what in investing in economics is far easier than when. When is a little bit of art and a little bit of psychology. Some people, you saw a column by Paul Krugman a couple days ago, saying, well, the worry warts are obviously wrong because we're still of low interest rates in the U.S. and nothing terrible has happened. Well, here's my second worst sentence. If anyone remembers earlier, I had my first worst sentence. My second worst sentence is Greece wasn't Greece till it became Greece. They were building up problems for years and years and years, and very quickly moved from, maybe this is something to worry about, to a crisis. Markets and people are like that. So I am going to entirely evade your question in case you didn't notice. But we are heading towards a very different, and both you guys said a very different kind of a cliff where we realize that we can't pay our debts, and we're being told there are easy ways to pay our debts that don't work. And it will matter a lot at some point. Picking the actual day, that's for a higher pay grade than mine.
Cliff, we will continue in just a couple of minutes. Cliff Asness of AQR will take this opportunity to say thank you and also goodbye to Jeff Scott of Wurts Associates. Thanks very much for being here.
Thank you for having me.